and see what's going on with the war, especially oil. And now they're threatening that they're going to block, I guess it was the Red Sea. Cost of oil stays at $100 range or close to it, and it just sustains at that level for a sustained period of time. That's where it starts putting pressure on the overall market. Yes, volatile, but it's not completely way off from its highs.
Once you break the 4.5, then it's like, oh God, are we going to hit 5? Hello and welcome to the Wise Money Guys radio show. I'm your co-host, John Scambray. I'm here with my partner,
Giuseppe Visconti.
And we are certified portfolio managers and long-time investment advisors that specialize in helping people who are retired or about to retire manage their money. As always, if you like the show and want to get together for a no-obligation consultation or have questions of any kind, you can give us a call at 916-967-3500, or you can visit our website, wisemoneyguys.com, for more information and important disclosures. This show is sponsored by One Source Wealth Management. We are a registered investment advisory firm, license 319078. Our main office is out of Granite Bay, California, but we also have office locations that could be near you, either in the Bay Area or the Tahoe, Reno area as well. So we've got a pretty big agenda today. Obviously, there's a lot that has been happening, whether it's the conflict in the Middle East.
Yeah, still uncertainty out there. Nothing's been resolved, and we're just kind of a wait and see. And markets are in that same predicament, right? Wait and see what's going on with the war, especially oil. There's been some fluctuation with gold. We'll touch on how the stock market's been reacting, what the stock market might be telling us as far as what the stock market thinks is going to be going on with the war. Is it going to be long-term? Is it going to be short-term? Also bonds, which is affecting interest rates. So bond yields or interest rates of bonds, the 10-year Treasury especially, we've talked plenty about in previous shows, and how that's moving borrowing cost up, like mortgages and car loans and so on and so forth, and touch on all of it.
Yeah. Hopefully after listening to this show today, we will instill some calm. I think overall, yes, there's all these different things going on, but no need to panic, in my opinion. But we'll talk more specifically about why you shouldn't panic, and more importantly, what to do and what we're doing as far as in reaction to all the different things that you just mentioned. But let's get started. And it just drives me crazy. I think the sensationalism,
when you take your car in to get repaired.
Yeah. So we don't want to get you fired up after what you experienced
this morning
at a dealership.
Holy cow.
This fine morning. But,
yeah.
But where I was going is that I think that the reaction is an overreaction.
What reaction?
Meaning
stock market,
to,
oil,
the oil
people's
just
reaction
swinging wildly. I mean, clearly after a month of the conflict in the Middle East with Iran, clearly it's done nothing to impact our supply.
The production of it.
It really hasn't done anything to impact world supply. Russia and China are still, unfortunately, getting their oil delivered through the Strait of Hormuz. Saudi Arabia and other big OPEC countries are delivering their oil through pipelines and other means. The U.S., of course, is net exporter of natural gas and barely imports any oil. I mean, we have more oil than we even know what to do with, and we've ramped up our production. Don't forget, we've also, now have unfettered access to Venezuelan oil.
Right.
And so it's really just
not Cuba, though.
Well, that's the whole point. Cuba, and I think the regime is going to fall there. I think communism is going to fall, just like it did, during the Reagan years in Eastern Germany, and I think it's going to fall in Cuba.
The big thing is just the freeways, right? The highways for the supply to be distributed amongst the world. Not so much of an impact for us because we don't rely a whole lot on oil from Iran. But there's other nations, especially that they're obstructing, which is the Strait of Hormuz. And then now they're also threatening with the negotiations back and forth with, the 15-point, plan that Trump sent to them. Then they're sending back, and we can get into, their 5-point, I think, plan back. But now they're threatening that they're going to block, I guess it was the Red Sea.
Yep.
Right. So it's just the supply chain highways of the supply going out and the speculation.
Just a highway, not highways, just a highway.
What is it, like 20% of oil travels through that passage?
Yeah.
So that's the big, and it's not the impact of that oil traveling through that passage that makes it to United States, which is we're directly impacted. It's the other nations and the speculation of, well, how long is it going to be held up for? And if it's held up for, we talked, I think it was last week's show on the release of supply, right, through the IEA, International Energy Association. Yeah. But that supply, I think, was going to grant another 20 days worth of oil. So then does that highway, Strait of Hormuz, get freed up in 20 days? Or now it's less than that. It's like 12 days. Or does it drag on for another month? Right. And so that's the whole speculation, just like anything else. I mean, we see it all the time with just earnings calls on like NVIDIA or other stocks where they've had killer earnings. They've crushed, top and bottom line revenue, and forward guidance is promising, but then the stock goes down, right? Or the stock goes up or whatever, if there's some sort of news out. And that pressure is if the per barrel, cost of oil stays in the $100 range or close to it, and it just sustains at that level for a sustained period of time, that's where it starts putting pressure on the overall market. And you see it across all different sectors that have nothing to do with oil. Even. Yeah.
Well,
but you're right. Again, I mean, is it affecting the supply and the production of, especially here in the United States, of
not at all
the producers of oil?
We're increasing supply to beyond what we even need.
Right.
So it's just
by millions of barrels.
It's ridiculous. And
but we see it at the pump, nevertheless.
Exactly. But what I'm saying is, as a reaction, don't overreact. That's what I'm calling for, is that, yes, you see this, affecting the speculative side of things. And therefore, because of that, now everything is selling off. And again, it's an overreaction.
Yeah.
And it's, again, to me, it's a buying opportunity.
You got to digest the information and take it with stride. I think I was on a call with one of our clients this morning. He needed to raise some capital because he's buying a house. But we got on a side note, and he was talking about everything that's going on in the world. And I said, you know what? I said, I go on social media once in a while and just kind of see what's out there. I said, but it's hard to trust the information that's out there. I'll see videos, and you and I had talked about it, of the aircraft carriers that are out there, and there'll be a video via AI, obviously now, which is kind of the negative side of AI, that they're blown up. Israel and Tel Aviv on fire, that they've just been bombed. All these different things, or
our own media.
The supreme leader's son is still alive, and he's in the hospital bed. It's like you can't. I said, if I just sat there and watched the news and social media, I'd be so stressed out. I'd be planning on how to build a bunker and go live under the ground for a few months, right? And that's the problem. So I just try and stick to financial news, charts, economic data, and that's it. And if I see something filtering through economic data and charts and what have you, there's no narrative, right?
Well,
there's no.
Here's my advice. Absolutely do not panic. I think this is, like I said, overblown, over sensationalized, especially our own media. The left-wing media is rooting for America to fail. That should tell you everything you need to know right there, that our own, people, our own politicians are hoping that this destroys, our country economically, not because they have any care about, the wealth and prosperity of this country. It's just about trying to take power back in the midterms. So you see ABC, NBC, CBS, MSN, MSNBC, CNN, CNNBC, Bloomberg, Yahoo Finance, on and on and on. A lot of the big sources doing everything they can to disrupt how good and how strong and how capable the U.S., our economy, our prosperity, our productivity, everything that is been a 180-degree turnaround since the last administration, and try to go back to, what we had, a country in chaos, losing all of our manufacturing to other countries around the world, being dependent on countries like Iran for oil.
Well, Middle East in general.
And Middle East in general.
OPEC.
And letting them take it to us and beat us up at every turn, whether it was, trade imbalances,
like a strong arm,
energy, production not being done here, open borders, hundreds of millions of people around the world taking advantage of those imbalances, and our dollar destruction by our own people, by our own politicians whose agenda is to destroy, in my opinion, the value of our economy so that, again, they get back in power. And unemployment is still low and still at full employment.
There you go. So the data, right? So everything that you just explained is your opinion. Do we have evidence of that? I don't know. There's going to be one side's going to say one thing, the other side's going to say the other thing, but where you're not going to get that narrative and bear it into it and get into opinions and I think this and that and blah, blah, is unemployment, like you just said, is low. The stock market, yes, volatile, but it's not completely way off from its highs. I mean, single digits, 5-6%, maybe 10% from its highs this year. And this is with a war going on, right? This is with the Fed's just meeting recently and saying that we're going to take a pause and inflation worries come back. So what that tells you is that the resilience of the U.S. stock market and economy is saying pretty much what you said so far, not overreact. We think this is going to be a shorter term. This is not going to be long drawn out and become a systemic risk. And that's why you're seeing the market be as resilient as it is.
You're listening to the Wise Minded Guys, John Scamber and Giuseppe Viscani. Stay tuned. We'll be right back. Welcome back to the Wise Minded Guys radio show. I'm your co-host, John Scamber. I'm here with my partner, Giuseppe Viscani, and we were talking about, obviously, the conflict in the Middle East and how it's impacting the stock market, which is why we talk about these things, because we care about people's money, their investments, and their overall, ability to retire comfortably and be happy and not stressed no matter what's going on. And that's really what I see our job as, whether it's just talking on this radio show or you've hired us as a client, is to, do that heavy lifting so that you don't have to. And I mean, you, the client, don't have to, because
we do all the stress.
We do the worrying.
Yeah.
We go bald.
Yeah.
Worrying for,
I was just thinking what we should do is just set up our office more like a spa. When you go in to get a massage.
Yeah.
It's like the lights are a little bit more dim. They have some soothing
nice
music
and candles.
They have some fragrant aromatic like lavender and things that really just de-stress you and calming, and that's what we should do here.
And that's what we're calling for, right? I mean, again, like you said, the facts, the data. Yes, a lot of this, as far as whether or not you believe, this is one side versus the other, which I 100% believe. And I don't think that's opinion at all, because you see it in how, our institutions and what they support and how our politicians vote, and what the news is on a particular a slant from one side of the aisle and how it is on the other side. So, those those things are more than opinion. But at the end of the day, like Giuseppe said, the market is only, single digits off of its all-time highs. And in fact, some of our
which the all-time highs is very high. I saw a study that if we had
was 50,000 and now it's 45,000 ish.
Well, I saw a study that if we have Great Depression like reaction, let's say this all blows up and it causes recession or depression, and we have a reaction back like when we had the Great Depression, that drawdown in the stock market would bring us back to not even to the lows of COVID 2020.
I mean, it's all about just we get spoiled, right? We have short-term memory issues. If you're not making new highs all the time, then with that euphoria, that's one side.
Fear is greater than the euphoria,
right? So on the other side, it's like, oh my God, the sky is falling.
Yep.
And the Dow, is in the 46,000s roughly. And, its all-time record high was 50,000 just a couple of months ago. So you're talking it's off by about 4,000 points, which is 8%, still
right.
Single digits.
Right.
The NASDAQ's at 21,000 roughly, and its all-time high is 24,000. So again, off by about 3,000, which is, what is that? 7% roughly. So again, still single digits, and the NASDAQ's the worst, of the big three, the Dow, the NASDAQ, and the S&P 500. Right. The S&P 500, you're looking at 7,002 as the all-time high, and it's at, call it 6,500, depending on, how we open up on Monday.
It's about 7% or
Again,
so, 7-8%.
So most of them are right in line with about 7-8% at the worst, which is single digits. I mean,
this is the high. So it's
off of the all-time high.
Yeah, it's the peak to the trough, and the typical average peak to trough, meaning that in a calendar year, let's say the stock market, whether it's S&P 500 or NASDAQ or whatever it is that you follow, hit a high in February, and then something happened with the market or the world, and everything sold off and it hit its absolute low in June, and then it started rallying back up and finished the year, let's say, positive. That measurement from the peak in February to the very low, the valley in June, that's the maximum drawdown. And the typical drawdown in a given year, when you look at averages, is about 14%. So we haven't even had the typical drawdown in an average year at this point. But when you just focus on the news and everything that's going on and what could be, and what if this happens, and what if this escalates, and what if that, you start worrying, and it's almost like we dropped 25%. And yeah, short-term memory. April last year, it's been less than a year, right, that we had a situation where markets dropped 20% when we had the Great Liberation Day, right, and all the tariff policies went out. So is this going to be something similar to that, where Trump comes out hard, with negotiation tactics and says, we're going to do this, we hit Iran hard, we're going to do that. Well, but then maybe now it's being digested a little bit. There's more negotiation. There's some delays to some of these threats of, if you don't do this, then we're going to blow that up, and so on and so forth. Now he's got, from what I heard, a meeting with Xi Jinping to see if they can figure something out to de-escalate. So I think my opinion is we'll probably see somewhat similar to what we experienced in the tariffs. He came out hard, put it out there, and just went, high. It's just like you go to a car dealer and you say, hey, I want to buy this $50,000 car. I'm going to give you $35,000.
I don't know why they're not realizing, meaning when I say there, I mean the United States. It's pretty simple. We should fully block the Strait of Hormuz. And you're hearing that here first. That's my opinion. Let me tell you why. Because Russia and Iran rely on Russia and China rely on Iran for a massive chunk of their energy needs. And they're still getting their tankers freely flowing in and out of the Strait of Hormuz.
Mm.
You block the Strait of Hormuz completely. Now, all of a sudden, watch how quickly this gets de-escalated, because now China all of a sudden would be going, Iran, you need to...
China and Russia putting pressure on Iran.
Right, exactly.
To de-escalate.
And they don't care, because there's, unless Trump is going to Xi Jinping and doing something like that, or going to Xi Jinping and Putin and going, okay, maybe it's not block it for, other, or worse, let's take out that Kanga, I think it's Kanga Island, where the main...
Isn't that the baby kangaroo character?
Well, somebody will I'm sure is going to email us or call us or whatnot to say, oh, no, it's the island where it's their main, where they fill up all the tankers, and a huge refinery of Iran, and it's the main artery at the top of the Strait of Hormuz right there. And you take that out, and then it does the same thing. Now all of a sudden, China and Russia aren't getting any oil out of the Middle East either. And so, that would change everything directly. But as long as you have the two countries that get, a fourth or a fifth of their oil from...
I think it's 20%?
20%.
China is 20%.
I mean, so you want to end this even early, and you want to cut off the spigot to all money to Iran to, hobble along, trying to, trying to block the strait still. Just block it all together. Just the opposite. It won't hurt us. In fact, now people will be coming to the U.S. and Venezuela, Canada,
that's
other countries more.
I think that's why we're doing this, actually.
Right?
That's just my opinion.
So,
but on the other side, playing devil's advocate, I know you love when I do this.
Yeah.
Is
when your liberal side comes out?
No, it's just playing devil's advocate. There's two sides to everything, right? If we're going in there and just taking over this and taking over that, and then just controlling this and controlling that of international waters, then what does that put out there for other big nations to later at some point in time do the very same thing, right? With international waters,
what do we need
that impact our trade?
What do we need?
Right?
What do we need from other countries? That's
specifically with Strait of Hormuz, not as much as other nations, but there are other passageways where we do need that, right? And they're also claimed as international waters,
if we're going to be
like the South China Sea. Right. And there's been issues with that.
There's nothing
where they're making islands out there
anywhere.
And there's been some interference. So now if all of a sudden they level up and then they start saying, well, okay, you guys blocked it over there, impacted us, and then tried to do some negotiations, we're going to do it with your trade paths, international waters. So that's the only problem that I see with it. I understand your point.
I think it's going to
get like a quick resolve,
because listen, as the greatest country in the world, who for the last 50 years plus has been offshoring things to be reliant on all these
that's our own fault.
Adversarial countries. This is exactly what we need, in my opinion.
That's our own fault,
right? It is our own fault. We don't need
we should have the whole time just connected ourselves with allied countries or neutral countries to be that, but to have our manufacturing and our pharma and stuff like we realized in COVID. And that really stems from these twisted leaders and politicians that line their pockets that we don't see, that go through shell companies and so on and so forth, that make these
stolen trillions of dollars,
that allow these policies and laws and all these different direction trades and manufacturing here and there with adversarial countries. And now we're in the predicament that we're in.
Yeah. So again, in my humble opinion, this just puts more pressure on us to realize that the lane we're in, the way we're traveling is the right way. This again helps, reassure us that this is what needed to happen. This is the right approach. This will again stimulate us doing more things at home for ourselves and protecting ourselves at home in our way of life. Because again, it just proves more and more and more how unreliable other countries are, and actually how adversarial they are. And
it's been used as leverage, right?
Right. If we can block giving money to any of these countries around the world and now just start taking care of our own, not only would the dollar go up in value, our debt and deficit, we could start paying off and balancing our budget and paying off
a big problem.
Our debts.
That's part of this too.
Unemployment would reach the lowest levels in the history of measuring, from the Bureau of Labor Statistics. Unemployment would go, there would be like back in the Roosevelt, a chicken in every pot, and so this in a way,
it's a good thing I have a couple chickens now.
is a good thing, because it's making us realize, and politicians will start running on, hey, we've got to protect the homeland, protect our jobs, protect our infrastructure, protect our way of life. And this is just another thing that proves that that's the right path to be on. And it will make everybody more prosperous. The more stuff we bring back to our own shores, the better off we'll all be.
As long as it makes sense.
And again, you're listening to the Wise Money Guys, John Scambray and Giuseppe Visconti. When we'll come back, we'll talk about, again, how it's not time to panic and how this may be a great time to take advantage of some of the dips in the big names. We'll be right back. Welcome back to the Wise Money Guys radio show. I'm your co-host, John Scambray, and I'm here with my partner,
Giuseppe Visconti.
And, you got me so fired up on how patriotic we are. I am. Our firm,
you're over here waving
especially passionate about helping our clients really take advantage of all the decades they put into saving and accumulating and wanting to have as good of a life as you could have for their families and their kids. And ultimately, that's what we feel our job is, because without your wealth, without your hard-earned savings and all the work you put into it, we're here to help defend that. And so that's what I feel our job really is. And the way we do that
and create longevity
is by having a plan, a written plan, having goals and objectives, your goals and objectives put into writing so that we can manage the portion of your financial lives that we manage, that we can manage to that plan. And when you have a plan and you have goals and objectives, it makes our job easier to help you not make mistakes. And that's what I'm really worried about. And that's what I'm fired up about. And that's why I get off on these tangents about the news and, some of these things and the adversaries that we now have and have known for a while, but weren't doing anything about it. And hopefully the long game for us is even greater wealth and prosperity and better, employment numbers and being able to lower taxes and so on and so forth. And
so far taxes have been lowered.
Taxes have been lowered.
People who are doing taxes for last year should be noticing a little bit of a bump up.
Yeah.
Unemployment is still low. It's higher than what it was, but still in a great zone right now.
And interest rates are out of control. Early on, you mentioned tariffs and the what we saw at the beginning of last year, where we had a major crash in the values of the indices and the value overall in the stock market. But no inflation came. No out of control inflation came from tariffs.
Right.
Now, we're going to see a little bit of energy inflation, right?
Yeah,
obviously, with gas prices. But what?
It depends on how long.
Depends
how long this is sustained.
More so in the state of California than in the rest of the nation.
California has had perpetual
so
inflation on gas.
It's not going to impact the nation as a whole as much as it's going to impact Californians. All the more reason why to either come to our seminar coming up that I haven't mentioned, and I will,
in California,
or call us for a no obligation consultation, because we're not panicking. We are the defenders of your retirement and your investments and your wealth. And if you've been following us, or if you're a client of us, you aren't panicking. And in fact, you're wondering what we're buying and what we're doing, and looking at your accounts and each day and seeing that, we're not experiencing
not as bad as
what you would think we were experiencing
when you watch
based
the news,
on the news.
Yeah, right.
So call us at 916-967-3500 to come in for a no obligation consultation. We'll do a free retirement plan analysis for you. If you don't have a plan or haven't done a plan in a long time, we're going to do one absolutely no obligation and free of charge, so that you can decide if the planning process and the way we manage and actively manage money is the right way for you. Again, call 916-967-3500. The other opportunity, if you're listening, is to join us for our seminar in Walnut Creek at Diablo Hills Golf Course from 6 to 7:30 p.m. on April 29th, which is a Wednesday. Again, at Diablo Hills Golf Course from 6 to 7:30 p.m. on Wednesday, April 29th. Call to register. We're already just started, talking about that and putting that out there, that we're going to have that. And it is so timely to make sure that, you've got the best plan of action going forward, the best roadmap, the best people at your side working for you to get you through, these turbulent financial times.
Right.
Call 916-967-3500. I was just looking at, the 10-year Treasury, and it hasn't broken through 4.5. It's flirted with 4.5 a little bit. And that 4.5 is kind of a barometer of interest rates starting to really impact, access to capital, because people, quite frankly, will maybe kind of consider borrowing.
When it gets to 5%,
I was just going to say, it's really the 5, but once you break the 4.5, then it's like, oh God, are we going to hit 5?
Yeah, 4.25. I mean, some of the economists that I follow, 4.25 to 4.75 right now is a normal range, you'd call it. Once you start going beyond that, and especially when you get to 5%, and what we're talking about, if you're saying like, what are you interest rate of what is the 10-year Treasury bond, the U.S. Treasury bond, and there's 2 years, 5 years, 10, it goes all the way to 30. But the 10-year Treasury bond is really what's used as a barometer to see where interest rates are at. And, is the bond market signaling inflation, or is it signaling a calming environment? And right now it's been spiking up, which is the worry for some inflation. And how does that directly impact you? Well, if you're going out there and trying to get a mortgage or refinancing a house, those interest rates have gone up. Before they dipped below 6%, and now they're approaching, from what I've seen last, was around 6.4% for a 30-year mortgage. That also impacts you if you're getting any other loans out there, like a car loan or so on and so forth. So that's how it really impacts you, on top of the energy increase on, going to the gas pump, especially here in California. But we're in a normal range. So there's no red flag or signal when we're saying, hey, interest rates are going up, or the 10-year Treasury is going up. Not at this point. And so far, the stock market, like we talked about, being not so off their all-time highs, and, long-term bullish. We're not in a bear market or worried about any type of systemic risk. Really, the only thing I think we're watching right now, that what I'm concerned with to see if it becomes a bigger problem, is a private credit market, because that has shown some financial cracks. Now, if the oil stays at a higher level, puts more pressures on the market, puts some pressure on inflation and some of the upcoming inflation data, and this sustains at a longer period of time, or then the feds are going to continue to have to pause and not cut rates any further, but then also put some pressure and interest rates go up and put some pressure on private credit markets. That's where it can cause some more volatility even outside this Iran deal. But so far we're not seeing any major red flags, right? Especially not to the point where some of these news and media that are putting out there of like, oh no, well, this is what's going on and this is what could happen. And if this doesn't happen and that can happen and so on and so forth. It's not, we don't see any major red flags in that area.
Yeah.
Really.
The good news is that we really liked fixed income, over the last couple of years, especially when interest rates went up.
Which are bonds.
Because when interest rates go up, as long as you don't have a lot of debt, and most of our retired clients have no debt, then it's an investment opportunity, right? Because bond prices are down typically when interest rates go up, and you're getting things at par or at a discount. And we're still buying bonds. We still like bonds because coupons are in the mid, and even seen some in the high fives.
Yeah, and to put it plainly in layman's terms is if you're retired and you're a saver, and you're living on a fixed income at this point in time, or you've saved what you saved and you're not accumulating anymore.
Yeah.
When interest rates are high, you can go walk into a bank right now and get a CD or a promo savings account. You see them, even American Express and Poppy Bank and some of these smaller banks are giving 4+% interest on a high yield savings and so on. So we haven't had that. I mean, recently it's been here for the past couple of years, but prior to 2022, when inflation really went through the roof,
savings account was 10 basis points.
Yeah, it was a fraction of a percent. And so it's been a long time since we've seen that. So
and a CD was 0.5% for a year.
Right. So people who have accumulated and savers and retired and people who are on fixed income, that's great. And so that translates not only on high yield savings, CDs, but also like John was saying, fixed income, which are bonds, which are the same thing, which then you get even a higher interest rate that you can lock in, because when you're buying individual bonds, then you have actual maturity dates. So it's spelled out. You know how much money you put in, you know how much interest you're getting, because it's basically a contract. Let's say you get a JP Morgan bond or Wells Fargo bond or anything out there that says we're paying 5% in interest. They've collected your money. They have your money in return. They're giving you 5% every year. Now, it doesn't matter what the market's doing or interest rate environment, whether it's going up or down, you're getting 5% every year on that money that you gave them. And then when it matures, you get principal back, and you already know what that's going to be, and everything is spelled out.
Yeah, my advice, especially with rates still being decent from an investment perspective and a price perspective, is that, focus on what things pay as far as what cash flow you'll get, on the top, off the top from the investment. Focus on dividends, focus on interest rates. Don't focus so much on trying to, beat one of the indexes,
pick
or
the winning stock,
be a stock picker. Because that's where, right now you're really worried, because if the only way that you're making money is that, okay, I paid, a certain price for a particular investment, and I'm going to sell it when it hits a higher price, and then that's the only return on investment I get from that. That's tough to do, especially in the volatility of the last couple of years, where, unless you've got, really a strong gut, right, to buy when things are down and then rebalance and sell when things are up. And most people don't. They buy high and sell low.
You mean investing without having emotion, getting involved in it?
Exactly. Yeah. So one of the things that I highly recommend is that when you are working with an advisor, hopefully they have a plan in place for you, and hopefully you have good goals and objectives and a realistic understanding of what you need to make, versus, just hearing that, oh, the S&P went up, 20% last year, and God, I want to make 20%.
Did I beat that?
Did I beat that?
Yeah.
If you know that you only need a 6 or 7% return each year to have a lifelong income in retirement, on, the assets that you've, accumulated and the other resources that you have, which might be income from rental properties or, of course, Social Security, as well as I might have a pension too,
right,
so on and so forth. But once you know that, hey, based on the 500,000, the million, the 2 million, the 5 million, whatever you have, if you only need, a 4, 5, 6, 7% return, then why risk going for a 20% return and only getting that return if you buy something was bought at one price and you need to sell it at a higher price to get that return on your money? Focus on dividends and interest and what investments pay you right now. That's my 2 cents. Keep listening to the Wise Money Guys, John Scambria, Giuseppe Viscani. We'll be right back. Back to the Wise Money Guys radio show. This is John Scambria. I'm here with my partner, Giuseppe Viscani. And once again, if you would like to come in for a no obligation consultation, call 916-967-3500. If you want to see us live and see how we are addressing and helping our clients address and deal with volatility and staying,
on track to the financial goals.
That's the word I was looking for. Come to our workshop, our workshop for retirees. So we're assuming you're retired or about to retire if you register and you have investments and means that you're concerned about. That's who would sign up and attend. It's in Walnut Creek. We are listened to in the Bay Area all the way pretty much over to Reno and down to the Central Valley. So we do have offices potentially near you in those areas, but come to our Walnut Creek seminar on April 29th from 6 to 7:30 p.m. That's a Wednesday. Call 916-967-3500 at that seminar. We'll show you more specifically strategies that we're employing, how they've worked, how we think they're going to work, types of investments that are very timely and helpful to most of our clients and could be helpful to you as well to reaching your goals with the least amount of risk that you possibly could take based on those goals. Again, call 916-967-3500. You can also go to our website to contact us or to just get more information about us. Our disclosures are at the bottom of the page, but there's also regular videos that we put out on our website and social media. You can watch the show on our YouTube channel, Wise Money Guys, or just search for our names or search for Wise Money Guys. And when you see the one that has our names, you'll see this show on YouTube as well. But lots of resources. We're willing to give lots of information and advice specifically to you if you come in and sit down for a no obligation consultation. As I said already, we'll even do a free retirement plan that we can put in writing for you, no obligation whatsoever. And if you like that conversation and think we're the right fit, well, then decide to hire us. If not, no pressure whatsoever. Again, call 916-967-3500. So last kind of minute, the thoughts here, why we
I think
finishing up.
We've talked quite a bit, especially on the Iran situation and the pressures that it's putting on the market, how the media is portraying it, the economy. Where do we go from here? There's still uncertainty is the bottom line.
Yeah.
Nobody's got a crystal ball.
And there'll be lots of volatility.
Yeah. Nobody has a crystal ball on how this is all going to unfold. I think, this is probably taking longer than anticipated on Trump's end. Hopefully we'll find
the absurdness of that. A major escalation between multiple countries. And the expectation is that it was only going to be a few days, maybe a week or two.
There's no way.
Is absurd.
Especially since, the whole kind of premise was for 47 years Iran has been against us, and so we're going to
against the world,
and we're going to resolve it in 2 weeks. No, it's not going to happen. Yeah. So the big thing is figuring out these pathways, these highways, right? Strait of Hormuz and what have you, that's
Pipelines,
impacting oil. All that being said, where markets are right now, how they have been reacting to all of this news and data that's been coming in has been very resilient. Our economy, our stock market in the U.S. has
employment,
is all still intact, all showing resilience, which is a good sign for the U.S. markets. We're seeing signs both on Trump and potentially maybe in other nations of negotiations or even just open to talking. So that means that there's at least pathways of finding some de-escalation in all this.
Well, pathways, just real quickly, new pathways to getting oil out of the Middle East are going to be one of the results of this. You're already seeing, Saudi Arabia and other OPEC nations going, we're going to put more through our pipelines and other ways to distribute our energy versus being reliant on the ease of just going through the strait. So that's a positive thing that's going to come out of this as well.
Yeah. And hopefully, again, sooner rather than later. But, the structural, how the market and the economy is set up structurally is still bullish, meaning still pointing positive, not negative. I think these geopolitical, like most geopolitical events, like we've seen with Russia and Ukraine, before Russia and Crimea, and other geopolitical events have taken place, is that it ends up being a bump in the road rather than a total crash. And so we think ultimately that's what will happen. And so how long is this bump in the road going to take place? Is it going to be another couple months or so? Who knows? But you want to pay attention to, what are you looking for? Peace talks, the Fed response and the signals that the Federal Reserve puts out there, inflation data, right? Those are going to be the important parts.
More importantly, you've been listening to the Wise Money Guys, John Scambry and Giuseppe Fiscani. Please give us a call at 916-967-3500 to arrange that no obligation consultation or to register for our April 29th seminar for retirees or people about to retire in Walnut Creek. I hope you have enjoyed listening to the show. Come back and listen to us next weekend. Have a wonderful Saturday. Bye, all.
Have a great weekend.